Today we're going to talk about a very simple strategy that historically has turned $1,000 into $31 million. Dividends are one of the few solid things in investing. Most things, profits included, are estimates, but dividends are real cash paid directly from the company's cash flows and bank account straight to its shareholders. And so that's why when I heard this really simple strategy, I paid attention. It doesn't chase meme stocks. It doesn't rely on huge amounts of stock price appreciation. You don't need something to go to the moon. You don't need to pay attention, predict, or try and chase interest rates or the Fed. It's just a very, very simple algorithm that's built on real data and it's easy to execute. So here's how it works. You take the Russell 1000. So that's an index. It actually has more than 1,000 stocks, but you're going to rank it by yield. So you're going to take the highest yielders, put them first. In the middle, you'll have middle yielders, and the lowest yields will be on the bottom. So once you have the Russell 1000 ranked, you're going to split it into 5 groups based on dividend yield. And the one that we're really interested in for this strategy is actually the second tier, the second quintile of the highest yielding stocks in the Russell. And a lot of people ask why. Why would we not go for the first? Well, because the first quintile, those very top highest yielders, are often filled with distressed companies. There's a reason that they're paying out such high dividend yields, and they can get into trouble fairly quickly. Some of these, not all of them, are really sinking ships. But when we look at the data, that second tier, it tends to outperform the index as a whole just as often as the first, but it tends to be filled with stronger companies. So these are companies with solid cash flows. They have reasonable payout ratios. This is where you get the highest yield and the highest quality. And I mean, the beauty of this is all you've done is rank by dividend yield. And how good does this work? Well, it's been back tested. And if we look from 1930 to 2024, if we invest that $1,000, if we would put it into the S&P, we would wind up with about 8.6 million. If we use this strategy, it turns into $31 million. So what do you get? You get 201 companies if you buy the second tier, and you get an average yield of 2.62%. And if this is something you're interested in, I've given you the entire list in a spreadsheet that you can download. The link is in the description. So this is a really great way to embrace the power of simplicity and find high dividend yields with companies that aren't falling apart. Thanks for watching. See you in the next one.